So how to develop a plan. So we need a signal, something that says, hello, it's time to trade, and which way, long or short, up or down. We need an entry methodology. We need a stop loss methodology. That's the first risk management technique, stop loss. We also need a take profit methodology. Anybody can get into the market, but it's getting out where the profits and losses live. So we take care of very small stop losses, and we want our take profit to maximize our return. Position size, well, I say, look, initially, just go with minimum until you've actually got a plan that's proven profitable, that you've paper traded, and that is working well, and that you're working well. Because it's not just having a plan, it's the person who's operating the plan who's got to have everything together. So the plan can be world class, but if the operator's not world class, doing what they need to do, following the rules, executing flawlessly first time, every time, then it's not the plan that's useless. It's all got to be learned. So here's the overview. Write a plan. Well, I've just been through the 5 things that need to be in the plan. So you need those 5 sets of rules. Well, 4 sets really, because I say position size, leave it as minimum. And then you test it by eye. In other words, you take it to past charts and you say, well, I would have got in here, I would have got out there, I would have got in here, I would have got out there. Does it look like it would be profitable? That's just a by-eye assessment. But then you've got to do the back testing. You've got to take the past trades. So you've got to follow those rules in the past, and I'll show you what's happening with the advanced cycles paper trading. Once you get the plan working profitably in the back testing period, you lock the plan down. And then you take that plan to a new set of data, to a new set of bars somewhere else on the chart. Now, normally the back testings in the past, a long way back, maybe 10 years back, it might run for, say, 2 years, 3 years. Then your forward testing period follows that. That's forward testing 1, then forward testing 2, then forward testing 3. I advocate that you need at least 3 forward testing periods. Now, if you get a tick against the forward testing, then you move on to paper trading. In other words, you've locked the plan down. It's worked on the sight unseen data that's in the future on the charts. And then you work with sight unseen data day by day. That's paper trading. And you take real-time trades with virtual money. So this is all done in a demo account. You haven't stumped up any money yet as far as trading capital is concerned. It's all about learning what to do. G'day, sorry for breaking in, but if this content is useful to you, you might like or subscribe. And if you want to go deeper, head over to futuremechanics.com. You'll find access to a whole range of things there that you might be very interested in. It's the best place to start your journey into cyclic knowledge. Once your paper trading is clocking along quite fine, you're behaving yourself, you're following the rules, and everything seems to be working well, then you go to real-time, real money, and that's when your psychology kicks in and stuffs you up. Everybody's got psychological issues, and money at risk highlights those. And you can be dangerous to your wealth. It's all about a learning process. So I say when you start real-time, real money, minimum position size. And it's not until you get all of that working that you can crank up the position size model that you've decided to use. By then you will have worked through position sizing and you'll understand what all that means. And then you append a position size model to your proven profitable plan, and that is a substantial multiplier, or at least it can be. And that's the aim of it. Firstly, write a plan. Here are the details. For me, the aim will be the sorts of moves that I want to trade on a particular time frame. And those moves, those up moves and those down moves, are part of cycles. That's the way I see the world. I will choose a particular size cycle, and typically I work with a 20-week cycle. Investors would probably work with the 18-month or longer cycle. Those who want more work and think they can make more money might go to the shorter cycles. They tend to end up back where I am at the 20-week cycle. But everybody has got a journey and everybody's got to follow their own interests. So signal, entry, stop loss, take profit and position size being minimum, we're going to track those. We're going to have a look at the detail of each of those. We're really not going into position size at this stage.